Hello, hello. Welcome to this week's edition of the Mentor Club. This is Noah D. Flying solo this week. Excited to have some time to work with you. No major updates in the crypto world from Andy. And so we're going to get to talk shop and take a deep dive, do some market analysis, bring you up to date. And before we get started, per usual, we want to make sure we take some time to discuss our disclaimer. It's important that we remember we're here for educational purposes only, that we're not here to give you any specific trading or investing advice. And we all know that trading and investing involves risk. It's a game for grown-ups. And we are here to learn, to practice, to build our skills, so that we can participate with more confidence. But that's a very individual thing. And again, kind of up to you as to when you do that. And important to remember that you can lose money doing this. So that being said, we go in with our eyes wide open. And we're going to start out here just going through my weekly routine. I went through it a little bit last night, had some medical appointments, doctor's appointments this morning, so I'm just kind of sitting down to the market. It's close to 11:30 or so, and just going through, catching up with the market. Hasn't moved that much this morning, and it's kind of done exactly what I expected so far. Good place to start out with is you can really start your routine anywhere. I like to start with the broad market charts, so I almost always just go straight to my S&P chart. And I look at the futures, and I get a nice look at, we had that really good rally last week, and it came in, the volume dropped a little bit as it rose. So this is a little bit of information that I find useful. I mean, the market actually rose a little bit more than I expected. It put in some nice life to the upside, but then the volume tapered off. And then it hit that 200 period moving average and kind of known support, resistance, neighborhood ballpark. It's not exactly perfect, but there's some overhead resistance out there. And we have a little bit of an inside candle. Now that inside candle is high up, and what that really basically means is on the intraday time frame, it looks like we have a double top, and the tops of those two candles came in really close together. And when you have an inside candle, they call that a harami. And a harami, the lower the harami, the bigger the signal that there might be a reversal. So this is a high harami, again, inside candle. And if we were to go look at that down here on like a 30-minute time frame, you can see the double top right there. Boom, boom. And a little bit of selling pressure this morning, and a bit of an M for murder. And whether or not this has violated the little intraday trend, it's hard to say. I could probably draw one trend line to make me feel like it's violating. I could probably redraw that trend line. So if I draw it here and I connect those dots, that looks like a bit of a trend line violation and a violation of intraday support. Now, that doesn't necessarily mean we're going into reversal. We already see a little shadow here. I could probably pick this off, a different way where I say, well, I could pick off this pivot here and catch that one there, and maybe say it's just testing it. I don't know. It's hard to say. But that little downward move would be the very, very first sign of potential downward correction. Now, let me go ahead and clean that drawing up. And just see, I see a little selling pressure off that 200. And that 200 is a big psychological barrier. It acts as support, resistance. It's a catalyst, and we're between that 50 and the 200. Now, there was a death cross last week, which is a very bearish signal. And then we had this nice bullish week here, which actually should lead to a bullish engulfing candle on the weekly chart. So if we zoom it back out to the weekly chart, and there's a big bullish engulfing candle. So multiple time frame analysis, the reason we do it is not necessarily because we're day traders. We can be if we wanted to be. That's more of a day job. But it's just to gain some perspective. Like, what are the long-term people thinking? From the weekly perspective, that's a bullish signal. From the intraday perspective, the day traders might be done with their short-term run. Like you had a nice run, boom, it slowed down, double top. You might get a correction in here. There may be a small correction, could be bigger, hard to say. And then from the daily perspective, we just see one red selling candle. Typical volume for this early in the session. I don't know if it's going to end up above average, below average for the day. We have quite a bit of trading left in the day, but I do see a touch of selling pressure in there on the S&P. And as we look at I always like to go to a heat map as well. The heat map gives you an idea of where the action is occurring. So we've got energy sector strong, utilities showing some life, basic materials showing some life, aerospace and defense showing some life. So this is kind of that conflict playbook we've been talking about a little bit. If you've been paying attention to Andy and listened to any of our webinars / podcasts, et cetera, we've just been talking about, well, the market may see some volatility. Typically, I expect when we hear about conflict like we're experiencing now, which is right now it seems like the globe is hyper-focused on the Ukrainian conflict, and it's a pretty big deal by comparison to, say, some of the things that we've had going on in the Middle East and Syria, et cetera, et cetera. I mean, there's always some sort of conflict going on somewhere. But news of that tends to cause a couple of things. It tends to cause energy to pop, oil and gas pop, which is already a seasonal expectation for the springtime anyway. So I normally expect energy and gas to pop in the springtime. So I'm pretty bullish on energy. Utilities tend to do well. As people get more defensive, a defensive sector, not defense sector like aeroplanes and Raytheon and Lockheed Martin and General Dynamics, like the defense contractors, that's a different thing. A defensive sector would be where people would move their money as part of a sector rotation, moving it out of maybe higher risk tech stocks, for example, or higher risk growth stocks, into lower risk companies that have a strong foundation, good fundamentals, paid dividends, et cetera, or like utilities, people will pay their utilities. They may cut some of their discretionary spending, but they'll pay their gas bill, they'll pay their electric bill, et cetera, et cetera. So we're seeing some life in the utility sector. Now, basic materials also tend to pop, and commodities tend to pop. So, commodities, what happens is commodities like corn and wheat and metals and things of that nature tend to pop up in price as well. And if we're thinking about this from a perspective, I mean, you can think about it from a defensive, protective type perspective where we want to be able to move our money into the right sectors. We want to be able to reduce our risk. Sometimes the best defense is a good offense, vice versa. Defense wins championships. You'll hear us say these things as we talk about markets. I think it's completely rational to look at where the money is moving and to potentially look for opportunities in those areas. And then I noticed some strength in healthcare. Healthcare's got a little bit of strength. Berkshire Hathaway stocks are popping. That's one of those things where people are moving into a little bit more sound investment. And again, we can see like some of the software sectors getting beat up. Facebook is down pretty big, and discretionary restaurants, Starbucks, McDonald's, et cetera, retails, apparel, those are getting beat up. So as we think about those things, we might look around and see what kind of opportunities we can find. You can always go look at the groups and get a feel for what's been performing well over the last week, last month, last quarter. Over last month, energy, utilities, basic material, healthcare. Those are the top four. Industrials right behind. And then bottom performers are consumer cyclical. Consumer defensive not doing as hot. And that's more staples oriented. But you can see consumer defensive last week started to perform a little bit more. So over the last quarter, energy and basic materials are the two hot go-to sectors. And where to avoid, probably communication services, technology, and consumer cyclical, which is stuff we buy that we don't need, but we may want. Cyclical includes things like buying washers and dryers and refrigerators and automobiles and things that we don't always buy, that we buy from time to time. So wants versus needs. And that's a pretty good overview of the market. I also, of course, like to look at headline news and see what's going on. I kind of have my go-to places. I always like to check that economic calendar. So we go through our economic calendar, and you can, Forex Factory is a good little website for economic calendar. It's also a news aggregating website that's got a pretty big global collection for news. And let's see what they got popping up on the calendar this week. Fed Chair Powell spoke at 10:30 a.m. We could go listen to that or read up on it if we wanted to. That's always a big deal when we get Fed Chair Powell speaking. Got him speaking again. Looks like he's at a conference. And then we've got annual budget release coming out of the UK. You got Swiss franc monetary policy coming out, and some manufacturing numbers coming out of Europe on Thursday. Those are the kind of the big things that might move the market. I'm definitely usually interested in seeing what Powell has to say, and you can go, read up on his testimony about in medium term. I don't see a conflict between employment and inflation goals. Last week, the Feds had their policy statement, and they've given us the idea that we're going to see some rate hikes this year, up to 6 rate hikes, and their target is to get us up just under 2% federal funds rate. And so that basically would affect interest rates kind of across the board, whether you want to go, borrow to buy a house, or borrow for a business loan, or borrow, for automobile, whatever purchases that, business expansion, etc. that people borrow. They're wanting to cool off inflation. And so he thinks that they can keep the balancing act going where, this is just a little blurb. In the medium term, I don't see a conflict between employment and inflationary goals. He thinks that they can walk that edge and keep unemployment low while very incrementally raising interest rates. And I think that they might be a little bit of patience. I think the rally last week was that they sound like they might be patient with it. Keep an eye on is the form of the yield curve. Now, the yield curve is an interesting question. I don't necessarily need to open up Twitter. This is an interesting concept. Dynamic yield curve. And the dynamic yield curve, if you just Google that, you can find this little dynamic yield curve on stockcharts.com. And what the dynamic yield curve is the difference between long-term and short-term interest rates. And they have this concept called the inverted yield curve, which tends to occur as we're heading into recession. And it comes down to if the short-term interest rates versus the long-term interest rates. So here you can see 3-month, 2-year, 5-year, 7-year. Let me zoom in on that so you can really see that. And erase that. And this is actually a pretty good little economic indicator to check on from time to time, or especially when you hear people talking about it. And longer-term interest rates have better yields. And so what that means is, short-term rates are low, longer-term rates are a little bit higher. And what you want to watch out for is if those ever invert. An inverted yield curve would be when the short-term rates are higher than the longer-term rates, and that would be an indication that people are afraid to lend money short-term, and so they're raising the short-term overnight risk interest rates. And if you see an inverted yield curve, that could be a very strong sign that capital's running scared. And here you see a little bit of a drop in between 20 and 30 years. And so, people are willing to, risk, take a little bit better growth on 20 years, but at 30 years you see the rate dropping a bit. And what we watch out for is a horizontal yield curve and an inverted yield curve. And we've got this little snapshot over here This is kind of a fun tool, by the way. So again, you're looking for a dynamic yield curve, and you can find this little guy on stockcharts.com, which is pretty good little free resource, a lot of pop-up ads and things. And you can hit this little animate button, and it'll go back to like prior to 2000, and you watch this little line here for the times that it inverts. So I'm going to hit animate, and I'll pause it when we see it invert. So here it is heading up into the year 1999, 2000. And the yield curve inverts a little bit right as we head into the 2000. Right there, boom, pause. Okay. The yield curve inverted right in 2000, just as the market, and this is the S&P index chart, just as the market heads into this nasty recession. The short-term rates popped up. Now, these rates are up at like 5 and 6%. And so this is a different ballgame than what we're dealing with today with our very, very low interest rate, zero interest rate policy that we've had going on for so long. But that inverted yield curve tells us that short-term capital is getting nervous, and the price of or cost of lending money short-term pops. And so if we ever see inverted yield curve, and so I can hit animate, and you'll see that after the correction, it'll come back down after the crash, and it'll start to normalize again. So it's still inverted, kind of, okay, it's starting to normalize, still inverted. All right, there we go. Starting to normalize again. But the bottom doesn't come in for like 18 months. And the initial fear and risk kind of is overcome. And so, boom, they lowered rates, they cut rates, they cut rates, they cut rates, and they brought in the bottom. Now we've got that nice strong yield curve. And again, kind of marching it forward, 2003, 2004, 2005, 2006, 2007. We'll watch that as it stays pretty healthy through these years. So I'll slide it forward. I'm just going to cut to the chase. And now it's starting to go horizontal again in 2006. 2007, oh, it's going horizontal. Okay, warning signs. And you'll see it start to invert right here heading into 2007. Short-term money's getting scared. And then again, we saw that 2008 meltdown. And at this point in time, interest rates are around 3.5%, 4%, 5%, 3.5%, 4%. And then we go through the big correction, and they cut rates down, and they get down to where they get the rates down to zero. So again, the dynamic yield curve is no longer inverted. Okay, so now we can kind of watch this play forward. 2009, 2010, you got a healthy yield curve. You got longer term rates, tie up your money a little bit longer term, get some of the higher returns. 20-year rates, you can get a 15-year mortgage for less than a 20-year mortgage, et cetera, et cetera. And 30-year mortgages, boom. So you can see, that's kind of treasury notes and yields. And again, looks pretty good. Now I'm going to see if we can speed that up a bit and run that through and see if we see any other points in time where we see it go horizontal. All right, there we see it shifting. Around 2018, it started getting a little horizontal. I don't think it ever really inverted, but it got pretty shallow in its depth. There you can see some spikes in 2019 where you saw some spikes in the little short-term rates. And we can just keep an eye on that. Again, here we are 2020. Here comes that we already passed our little COVID blip, and we see it rising up into the current date. Here we are, 2021, 2022. And let's keep an eye on that. Is it starting to shift horizontal for us? Is it starting to invert at all? I'm not seeing too much fear out there right now in the short-term money rates. So there we go. We played that whole thing. Let me take that back to the end there. It got a little horizontal at about the 5-year note, and then the 2-year note, but like the short-term overnight stuff stayed really low. So that's just something you can keep an eye on. And again, you watch for horizontal, and you only check that probably quarterly. It's not something you check all the time, or anytime you hear him talking about it. So dynamic yield curve. There we got some new information. But that's something we can pay attention to. One of the things we keep our eye on is the form of the yield curve. So we know that the Feds watch that, and we'll keep an eye as they raise rates. We'll see where they go. So those are quick snapshots. Economic calendar, I don't see too much out here other than the Fed Powell testimonies. I like to go to briefing.com and just kind of read their little quick snapshots of the market, kind of their little news aggregate, what they're talking about. S&P's having a tough time cracking resistance. It's a 200-day moving average. We already knew that because we looked at the chart. And Fed Chair Powell to the NABE conference, the comments that caught the market's attention were the following. We will take the necessary steps to ensure a return to price stability, because they want to try to, bring inflation down. In particular, if we conclude that it is appropriate to move more aggressively by raising the federal fund rates more than 25 basis points at a meeting or meetings, we will do so. Now that means if they do a raise in the rate hike more than like a 0.25 increment, like a 0.50 increment, that means the Feds are really worried about inflation. And if they do anything bigger than a quarter point rate hike, that'll probably affect the stock market by causing it to sell off. And so we'll keep an eye on that. That means we really have to pay attention to the Feds this year. And they have those meetings about 8 times a year. You just keep an eye on that economic calendar and just watch for anything that says FOMC or Jerome Powell or anything along those lines of the Federal Reserve. So you keep an eye on those. Federal funds rate, 25 basis point meetings, we'll do so. And if we determine that we need to tighten beyond common measures or of neutral and into more restrictive stance, we will do that as well. So they're very hawkish on inflation. This was treated to a new sentiment, but in reality it was nothing new. This is all information we've known. That the Fed's chair intimated at his press conference last week was that he conveyed that the medium estimate for the target federal fund rate to 2023 would be provided in the summer. They're trying to shoot it up just under 2%. Nevertheless, it serves as a stark reminder that this isn't the dovish-minded Fed that the market has gotten accustomed to. The Feds have been super dovish, easy money policy for the last decade plus. And one time they tried to raise interest rates like 2018, the market threw a little taper tantrum is what they called it. So we'll keep an eye on that. Look, like we're here, the 10-year yield note moved up through resistance. Okay. So this is not nothing really that new. It's just putting it into context for us. Energy sector's popping, which we knew because we already looked at our heat map, and we're seeing that there's some information about sanctions and oil refineries. Was attacked by Houthi rebels, slowing output, and there's just information that's causing the price of oil to pop. Occidental Petroleum. Here's some ticker symbols we might look at. Oxy, MRO, FANG. We could jot these down. I have a position on Oxy, but I'll just jot these down. Just give us something to look at. Occidental Petroleum. I know Warren Buffett's piled in heavy on that. MRO, FANG, Hess, EOG, Devon, DV, or Devon, I'm not sure how you pronounce that, DVN, Halliburton. We already have a position on VLO. Apache's a fun stock to trade, APA. We already have a position on Schlumberger, SLB, and I'll walk you through those. And then CTRA. So, if you're looking for something just right here, these are just notable movers, people that are moving, and you might find some opportunities there. ZipRecruiter is worth looking at. The tight labor market, boys demand. So Zip, we could jot that down. And Zip makes me also think of like Salesforce, CRM type stuff. We can take a look at these and just see what we find. Okay, so there's some ideas for us right there just from reading our news. And then I like to go hit that little stock market update. And this is the current snapshot. And industry watch, energy, metal, materials, utilities, industrials. This is stuff we already kind of determined this already just by looking at our graphs and charts. And then places to watch out for: financials, consumer discretionary, and communication services. Near the 200-day moving average, we knew that. And crude oil is on the move again. Okay, so all stuff we know. Home Depot, Salesforce apply pressure to Dow Jones on Monday. So Dow Jones down, NASDAQ down, Home Depot down. So that could be something we look at. Salesforce down a bit. That's something else we could look at. Okay. So Goldman Sachs is down. And that for those, that might be a buy the dip. It's hard to say without seeing the chart, but we might find some opportunities there. It might even be bearish. Things that we also might look at, which would be interesting. Nucor Basic Materials. So we could jot down Nucor. And Microsoft is on the downside. Visa, Broadcom, Amazon, Tesla, those are all down. Mosaic is on the rise. Now, Mosaic is what I would probably call Basic Materials agricultural stock. And so I would go look at those like Mosaic. You could maybe look at Monsanto. I keep reading these articles about food shortages coming. And I don't know if that's true or not, but I do know that Russia, Ukraine combined make up about 20 to 25% of the world's wheat production. And then you got other major producers are China, India, and the U.S. and Canada produce a lot of wheat. And so what happens is during conflict, you'll see the price of commodities like wheat, like corn and other grains pop. Like they'll shoot up, and what happens is like China will stop exporting wheat, and India will cut exports, and the U.S. will start keeping their wheat at home and stop sending it overseas, et cetera, et cetera. And so that creates a price run on the commodities. It might be short lived. Conflict comes to an end, everything goes back to normal. It could be protracted, kind of prolonged and protracted out, and we don't know. But it's something for us to consider. So these are ideas that I'm just getting just from reading the news and seeing what they're talking about. Now, you can keep digging on news. You can go look at like the news little aggregation websites, like right here on Forex Factory. I can go click on news and I can go read headlines. And I don't spend that much time reading into headlines unless it's something I find I want more information on. FinViz has got a news aggregator that's pretty decent. You can kind of look at that. And again, I just look for headlines that I find interesting, and I'll occasionally dig in and read more. And so we can, this kind of also helps you just think about what to think. And most of the thing you got to remember with headline news is a lot of them are clickbaity. The titles are just sensationalized because they're trying to drive traffic to their sites. And it, might sound worse than it is. And so you got to take everything with a grain of salt. So, things, Kremlin relax, no significant progress, ceasefire talks, blah, blah, blah. You can keep reading on that. Back to our homepage here and the charts right there. I could just dig in here and start hitting all of these energy stocks and looking for, what's going on in oil and gas. And if you click on that, you might get a list of the candidates. And just boom, boom, boom. Oh, I see opportunities already. Apache's poised for a breakout, so I'm going to put a little star next to Apache. We already wrote that down. AR Antero looks like it's poised for a breakout. And you could also go click on this little chart button here and get a quick snapshot and see and I'm looking for breakouts or bullish setups. Chesapeake pullback starting to run. See, nothing that's too exciting. I could also put some filters on here, like get rid of the stuff that doesn't have average volume. I want over 1 million shares, and give me only the stocks that are optionable and shortable, and give me stocks like so we're seeing a little bit better filter here. I'm going to take that up to 2 million shares. Apache. Continental Resource Group looks like it's poised for a breakout. Canadian National Resources looks like it's poised for a breakout. CNX, ConocoPhillips looks good. I'm going to add that to the list. That wasn't on our list. And we already have some heavy, not heavy positions, but we have some positions in the energy sector already. And so I don't necessarily want to go in too heavy. Hess is poised for a breakout. EOG is poised for a breakout. Marathon Oil looks like it might be poised for a breakout. And you can filter and find stocks you like in your price range. Like Marathon Oil at $24 could be a stock trade for you, where you buy and you do a trail stop and just simple stuff. More expensive stuff like Hess out at $101, you could trade stock on that, but you could also maybe buy long calls or maybe consider something like a butterfly type position on that. And I have some option positions primarily on the energy sector. But that's kind of how I think. And I'm just talking out loud, walking you through, my routine, and just this is what I'm seeing. This is what I'm interested in. So that gives us some ideas of what to look at. Now, as I look at this chart, I could be worried about a little bit of a drop back. It could break out and pop up and retest that 100 and old support resistance neighborhood. Hard to say which way that's going to go yet. Let's run through the sectors real quick. Basic materials. It's popping. It's back up above the 200, but it's still below the 100, and it's testing this resistance. I'd like to see a breakout on basic materials. That might help. Energy looks strong. Energy sector is a nice pullback, popping and running. Financial sector still below. It's a back up above the 200, but it's still below the what do we call that? The 50 and the 100, and it's got lower high scenarios. So I don't have a lot of confidence in that rally yet. I find that because it broke down to new lows, and when it breaks down to new lows, and I see the rally and the volume kind of taper off of that, I see heavier selling pressure, big volume, big momentum. This rally is about 50%. This is a coin toss. I don't know if it's smack dab in the middle of support resistance. And so this is kind of distinguishing between bullish sentiment and bearish sentiment. It's like, look, hard resistance, hard support, 50%. You're in the middle. Big drop down, above average volume, rally up, tapering volume. Inside candle slowing momentum. When I look at that, it's slowing down in here, and this could either start to drop again, or it could power through. I don't know, but I have less confidence in that than I do in the energy sector, which is posted a new high, pulled into a bull pullback, and is off to the races again. That's way bullish. Industrials still below the 200. It does have a two-leg rally. Higher low is nice, but this is also out here in this big area of potential support resistance. It could start to drop again. Industrials, I have some confidence in, but not a ton at the moment based off the chart. It's got to break out above this resistance here. Tech, not a lot of confidence. It's rallied. It didn't break resistance. It's below the 200. It's got an inside candle. I wouldn't be surprised to see tech sell off again. Consumer staples, broken support, violated the 200, rallied back up, inside candle. This has got more of a downward bearish channel forming, support resistance, lower highs, tapered volume. Not a lot of confidence in the consumer staples as of yet. Utilities. Oh, look, they're up here possibly forming cup and handle. I mean, they're a little off the highs, but they're banging up against the highs, and I did not draw that line well. Let me try that again. They're banging out there against the highs, and so it's like boom, boom, and it could end up taking and causing a breakout. So I could look at the utility sector for breakouts, run a scan, see if we find anything. XLY's consumer discretionary. It did rally up a little bit above this volume. It's not bad. Inside candle, it's still below the 200 period moving average, so I don't have a ton of confidence on that either. Healthcare, it's back up above all the moving averages, and it's broken 2 levels of resistance. And so healthcare has got a much better bullish outlook, breaking those 2 resistances. It's overbought at the moment, and it probably corrects, but I wouldn't mind buying a pullback on that because it is back in a bullish posture, bullish footing. And real estate, it's kind of riding that 200. Don't have a ton of confidence in that at the moment. So my go-tos are energy, basic materials, some life, maybe. It's a maybe. Utilities look good, and healthcare look a little bit. XLV healthcare look a little bit better. That helps me inform my opinions a bit. Let's take a look at our futures watch and see what's going on with. Start out with crude light. Oil ripped down, boom. So I've got some oil futures that I bought just off this dip. I saw it come down and hit this kind of 50 period moving average ballpark after the big pop. Put in the doji, and I got in a buy and a trail stop. Our stop loss is above break even, and we are up $9,600 on that. Big profit off of oil. I also tried to pick off silver, not doing so hot. And I just built up some positions on corn and wheat just today, looking to go bullish on corn and wheat using some futures leverage. You can possibly trade ETFs on that, and futures are definitely not for beginners. But crude light, I think we're off to the races again on oil prices. Bitcoin's consolidating inside, like Andy said. Not a lot of news here. My archipelago indicator, AR high, zoom in on that. AR, write that down. $ARHI3M minus $ARLO3M. It's still posting bearish. It's not. It's neutral to bearish. And what this is tracking the stocks on the Archipelago Clearing Network, which is one of the big electronic clearing networks where all the transactions occur. And you're seeing more stocks post new lows than you are seeing new highs. At the moment, that number's 6. But they're tracking several thousand stocks. I think about 7,000 stocks clear on that network, including the over-the-counter stuff. So it's big clearing network data. If I see it turn green, that would restore some bullish confidence. But in the meantime, it's kind of bearish to neutral. We've looked at the S&P. Gold is in a pullback. It got really overheated and excited, pulled back. Support resistance. There might be an opportunity in gold. I also picked up a position in silver, expecting the same thing. It got overheated, short-term pulled back, and it's kind of fear. Fear causes people to go into that commodity. It causes money to change and rotate and get defensive. And anytime the market gets defensive, precious metals tend to do well. Okay, volatility index is back down at 24. That's still high. VIX at 26 is where I think options are for selling. VIX at 24, you could probably still buy options. And, it's definitely got kind of a trending look here where the market corrects again, that VIX will pop again. U.S. dollar strengthening and pulling back. This is the UUP is the ETF for the U.S. dollar. And it's showing some strength. Not a bad deal there. Dow, below the 200 still. Inside candle. And Russell, kind of neutral to sideways. And NASDAQ, 50-period moving average resistance inside candle. But decent rally on lower volume last week. So that kind of, again, informs us where we are at. I don't think we have any new insight from looking at that. So now I go through my portfolio, and portfolio is in a bit of a transition. I've been running all these condors and credit spreads working on the playbook, and they all expired. Not all of them, but a good majority of them expired this last Friday on March options expiration. And if you're curious, I'll show this to you. Just kind of what we've been doing in the playbook is learning how to write credit spreads, bull puts, bear calls, iron condors. We've also done naked puts and dynamic stock type stuff. But this is kind of how we did almost 100 transactions through the playbook. And we had some good transactions, some bad transactions, some stuff we tried to hedge that didn't work out so well. Out of 88 trades, we won 65, we lost 23, we were 74% profitable. Over the course of about 48 days, we pulled in about $4,182. I closed a few positions early to make those numbers look nice and to lock in some gains. Our worst trade was a hedge, or a position we tried to hedge where we lost $1,112. That was a big drawdown, kind of hurt. Our largest winning trade was also a delta hedge where we were hedging out a position trying to manage and control risk. Credit spreads are like a little base hit trading system. Our average income trade was $158. Our average expense trade was $266. These numbers don't make sense until you put it into the 74% context of winning. We were shooting for 80%. We came in at 74%. And this is just the transactions. And again, I'm showing you just the spreadsheet I used to track these trades. It's just a simple spreadsheet. You can kind of create your own. whatnot, or we have some spreadsheets that we can make available for you. But it's helpful to track your trades. And so we were averaging the average days in trade with rolling options and whatnot. We were in the average trade for about 18.4 days. And this is what a credit spread cash flow system would look like. And so if you're interested in learning more about that, we talk about credit spreads. You learn about that in Ultimate Options, and we talk about those here in the Mentor Club. I'll put on some credit spreads. This is in-depth how to manage them, and we spend a lot of time doing the practical application of how to find the candidate, how to place the trade, how to manage trade, how to delta hedge, how to mitigate risk. Some of them got away from us, and kind of the reality and messy part of trading. A lot of practical application in that. So that was really fun to go through for us, and pretty cool. So I've got some residual positions in here that don't look so great. And let me kind of walk you through the portfolio. So we've got a ton of just different positions in the portfolio. And I currently have some positions that are collared neutral. Looks like we got called out of some of them. And looks like we maintained our Apple stock. We got our Pfizer stock. So these are some core positions that we collared to neutralize, and those options just expired on Friday. And so we actually had some AMD taken away from us. And I can't remember the other symbol off the top of my head. Then I've got some speculative directional stuff. I did a speculative trade on Occidental Petroleum. This kind of falls into the thread of what we were just talking about, like the list of energy stocks. And I saw probably 5-6 different headline articles talking about Warren Buffett buying, and that's just because I read financial stuff all the time, Occidental Petroleum. And I saw that all the headlines I saw were this driving this price up with the rest of the energy sector breaking and running. And I saw the little pullback to the rising 9-period moving average with the little signal candle. And I decided to go in and build a small position. I could have bought the stock, and it pays a modest dividend. I built a back ratio that's good through May, very short-term trade. And what we did is we sold an in-the-money call. I ended up selling 2 of those, promising to sell the stock we don't own at $50. And they gave us $855 per contract. And then I turned around and bought 6 out of the money calls for the strike price of $65. So we have the right to buy the stock at $65, and we made a promise to sell it at $50. So we have 15-point risk times 2 contracts. So our max risk is about $3,000. And we ended up with a small net credit of $42 at the end of the day. And this trade is a purely directional speculation. It's a bet that it runs big. And so I was thinking, well, this thing just popped, it ripped. If it keeps on going and the energy prices keep going through the roof and the energy sector, if this thing pops to 65 or 70, the way I structured this trade out, if it pops out to 65, we could make a nice little $800. If it pops out to 70, we might make $1,900, $1,800, somewhere in that ballpark. And if we were wrong and the stock price dropped, we had pretty nominal risk. And if it really was wrong and it went all the way back down, we'd actually walk away with $42 in our pocket still. So a back ratio, it's called a call ratio back spread. It's an aggressive speculative trade that starts out with a delta that builds. You can see the purple line curves, and let me show you the position right here. And again, I typically go to sell an in-the-money option with a delta between 70 and 80. That's the rule I follow, between 0.70 and 0.80. And then I go out of the money and I try to buy options with the delta of at least 0.30 or better, 30 to 40, somewhere in that ballpark. And so at that moment in time, it was the 65s. So we sold the 50, and I looked at one, and I could get 1 by 3. I could sell 1 55, and that would give me enough money to buy 3 out of the money 65s. And then I just increased the position size to 2. So I did 2 by 6. And so that's what a call ratio back spread looks like. And it only makes us money if it moves up quickly. Otherwise, it's a race against time decay. And it gives us a negative theta. It's got a big vega. An increase in volatility helps this trade. A decrease hurts this trade. It's got a nice delta position. And of course, you could speculate with more simple stuff like just buying a call or buying the stock. But a back ratio basically gives us the trade where if I think it's going to move quickly and I'm worried about being wrong and it going to the downside, a back ratio is something we can do. And your risk is limited to the distance between the strike prices. And the way this trade can really lose is if it were to go out to 65 and we were to sit on it through May and the stock price expired right at 65 on the 20th of May. The time decay would sit and eat you alive. So Occidental Petroleum, I think it's still got some upside potential. It looks like it's just breaking out. So I caught it off the pullback, got lucky. It went in the right direction. It's breaking out right now. Volume's tapered off a bit, but it's still popping up above average on the buy side. And, we could go through and look at some of the other energy stocks and see if we have interest in those. But that's a back ratio. I got a butterfly on the cyclical stocks, and this is, I believe, just a neutral trade that I tried to leg into. I did leg into, but got rid of the risk by turning this into a butterfly. So this trade started out with a bunch of risk, $1,675 worth of risk. And I probably then turned around and picked up some additional risk and bought these 215 calls for $525, increasing the risk to about $2,200. And then as it popped up, boom, we were able to sell the $200 calls and bring in enough money to cover the cost on both. And so I have a trade that's pretty neutral with no risk. And if it keeps rising between 190 and 200, we'll have a little cash flow trade. But in the meantime, I have no risk on the trade, and it's pretty sideways. I don't do a lot of balanced butterflies. I do a lot of broken wing butterflies, but occasionally I'll wind up with that. Got a couple covered calls where we own the stock and have just written covered calls. Pretty simple, standard stuff. Looks like I need to write a new one on CPE. Dow. Got a sold put and short calls. Lowe's. We're in the money here. 25th of March. We could get called out. We've got 4 days till expiration, so our low stock could get called away from us. And it looks like a pretty break-even scenario. That was probably a defensive covered right. If you go look at Lowe's, stock price was getting beat up, and it went a little something like this. Owned 100 shares. We're really at break even about what we paid for it, but sold at 215. So we bought it at 226. Sold a defensive in the money covered call 215 to protect it to the downside, which left us with a potential $93 gain, but we were good as long as it stayed above 215. And so 215 was kind of down here in that 200 period moving average ballpark. And it got a little violation, and then it came back up. So that's a defensive hedge. This stock will probably get called out this week, and we won't own it. We'll end up with $93 in our pocket. And then rather than panicking, and again, we bought it at what price? $226.92. So if we picked it up at $226.92, I cannot recall for the life of me when I bought the stock. I'd have to go look at it. 226 is somewhere in this neighborhood. Probably picked it up off that dip. Boom. And then ended up getting forced into the protective call right. I could have also bought it on a breakout back here. I don't recall when I bought it. We can go back and look at the account statement. Bought it on 210. 210. Right here, 210. Not sure what I liked about that, but we bought it, and then I hedged it down to 215. I might have just been doing a protective call right demonstration. But yeah, so we got some stock positions, covered calls, nothing too exciting. ExxonMobil, I've got a covered call on it. Do I think ExxonMobil is going to pop? Oh, yeah. Okay, so when ExxonMobil got a little overheated, I sold the covered call and it dropped. I'm going to buy this one back, these short calls back. We sold those for $1.38. I can buy those to close for 67 cents right now. That'll uncover it and open up the risk graph to the upside. So I've got 4 of them sold. That's a double covered call. I actually over ratioed. I got 200 shares and I sold 4 calls out of the money to neutralize the drop back. And that kind of neutralized the trade and helped us endure this little drop back. Now that it's starting to rise again, I get those bought back. Hopefully those get filled for us. It'll take our risk graph back to straight bullish. Okay, so that was an out of the money call right when the stock got overheated out here at 90. Naked puts on international paper. This is Andy's trade. And Andy, Andy is a big fundamental guy and loves looking for deals. And I'm trying to double dip on this one. He likes to look for the fundamental stuff and international paper. I mean, they make boxes. And they had some debt issues and they were kind of getting their balance sheet worked out. And Andy liked it and saw that they were on sale and wanted to buy into it. And so he sold some naked puts and looking to pick it up. They pay a pretty healthy dividend at 46 cents and the stock's out here at 44. So, I mean, that's a pretty good. All right, we got our covered calls, or our ExxonMobil uncovered, so now we're just bullish on ExxonMobil. That also, ExxonMobil also goes into our energy play. So IP is just naked puts, and it's just a cash flow, and I'm sitting here trying to sell some calls on it. We don't own the stock, but I made a promise to buy it at 43, got paid $1.25 for 2 contracts, 200 shares. Then I promised to sell 200 shares at 48 for 20 cents. I'm trying to hope, kind of keep it in this range and kind of get the cost base broken down. Where if the stock price starts to run, I just have to buy the stock. But if it stays in this range, healthy, I can keep writing options on it until I do buy the stock, until I own it. So I can keep trying to get the cost base down. And the goal would be to, own it. If you want to own the stock, cut the dividend, that'd be excellent. They got earnings coming out in end of April here. So we got some time. But that's a pretty good old boring naked put and awesome little trade going on there. Iron Condors, I've been legging into and out of Iron Condors. I got one in trouble right now on American Express. And it's starting to run. This is just the bear call spread. Is it a I closed the bull put to lock in the gain, so I have just the bear call. So I need to move that into my bear call spread candidates there. Stock price is moving out. It's getting close to the short call strike. It's a little overbought. It's got overhead resistance, so I'm not going to panic on that. I'm going to see if I get a pullback. I'm going to move that to my bear call credit spread group. The rest of these are not doing much. They're just working on a little cash flow. Target call spread. That's also just a call spread. I closed out the put spreads because they look so profitable. Let's move that to the group and bear call credit. Okay. Bear call credits. We got a couple in there. They look like they're doing okay. Bull put credits. I don't have any out there, and I might add some. I could do it on some of those energy stocks we talked about. We'll see if I can build one of those out here. Broken wing butterflies. These are directional speculations on stocks that I didn't want to tie up a bunch of money in there. And I got 2 in the defense sector, like actual weapons and defense, like aerospace and defense. One on General Dynamics and another one on Lockheed Martin. And if you've watched the Mentor Club for some time, I like to use broken wing butterflies to speculate without spending a ton of money. So, Lockheed Martin's a $400 some odd dollar stock. And we've had this trade on since let me put that in there. Monitor, account statement, LMT. Since the 7th. And this was bought in anticipation of this breakout. So when I first started hearing rumors of the Ukraine conflict, the Russia-Ukraine conflict, that made me nervous, and just like everybody else out there, and concerned, and nobody likes the idea of war. But I do know that the tendency is that energy stocks tend to pop, and the aerospace and defense sector tends to pop. And I didn't know when or how much, and so I like to build broken wing butterflies because it doesn't take as much capital. And we were able to do a 5 by 10 by 5 where we bought the $400 calls. And I usually build these out of the money when I start. And I'll buy the first strikes right out of the money. And those cost $15.80, and I bought 5 of those. And then I promised to sell the stock out at $4.15, so $400 call by $4.15, and you sell twice as many of those. And then you turn around and you buy the next higher strike, and you try to keep it in balance, and those cost $8.60 for the 420s. And so that left us with a net debit of $2,100 and this bullish purple line. And I believe the stock was going to rise out past towards 415, maybe get past 420. And it popped and ripped way better than I thought. Ripped clear out to like 480 and then did a pullback, and it looks like it's on the run again. And we're basically just trading this purple line, and it is a theta positive trade. It's got a modest time, but it's really a delta trade. It was about building this 31 delta. And if you look kind of where our cost base is at like 404, so we're into this trade for $2,100, whereas buying 32 shares of the stock at $404, 32 shares of the stock, at $404, which we can't do now, obviously, because it's more expensive. But if I had done that, that would have cost $6,288 of capital outlay. So for a third of the capital outlay, I got a very similar position. Where if I had bought the stock, we'd be up around $1,100, and off of 6,200 margin, so that'd be a decent little return. The broken wing butterfly, we're up about $1,500. We actually have done really, really well with this, and time's working for us. And that's the broken wing butterfly. I did one on Lockheed Martin. It performed extremely well. I did one on General Dynamics as well. And General Dynamics, smaller trade with $495 risk profile, bought the 210, sold the 230s, so a 20-point spread, and then bought the 240s for a 10-point. So that's what makes it imbalanced. You want the upside max gain here at 50, what it says $505 to be, at least the same as the risk. And we're riding that purple line up, and General Dynamics popped and is looking bullish. And same thing, I got into it prior to the pop. I didn't know when exactly it was going to pop, but we did okay on that. And so for $495 debit, we've got about 100% return on investment on the broken wing butterflies. And we could build out a broken wing butterfly. Maybe we can do that on one of the energy stocks. I'll have to weigh whether I want credit spreads or just directional speculation. And then I did one on Valero. And Valero didn't play out as nice. It was a lot rougher. And Valero kept dropping. I was trying to buy the dip, and it kept dropping. So I ended up changing it from trying to leg into a spread to legging into a butterfly. And I ended up starting out with just the long call. I was actually trying to leg into a risk-free spread. And had $2,900 of risk. I bought 4 of these $90 calls, and I was just trying to sell 4 of the $100 calls for the same price that I bought them for these, for the same price. And the stock price just kept dropping, and that target got further and further away. So what I ended up doing was throwing money at the problem, buying 110 calls for 98 cents, so that I could sell twice as many 100 calls for half as much. So I ended up putting out those 100s, and that put the little price target. The big difference in why I did this is trying to leg into the spread with the stock price kept dropping. The original target was like right here at resistance, but as it kept dropping, the target got further and further away, how far it had to go to get to where it would leg into the risk-free spread. And so because it was getting so far away, when it was down in here, and I was kind of like, oh man, is this thing going to go? It's like the one energy stock that's not running. I ended up buying the way out of the money 110 calls so that I could double up and sell twice as many 100s, and I got that target down into here. Then it finally popped, and it hit that target and sold those 8 $100 calls for $420. Originally, I was trying to sell them for $725 to get to risk-free. And so by buying these, I was able to get it into a risk-free butterfly, balanced butterfly, same distance between the strike prices, which kind of caps out your gain, neutralizes the trade. You know, it could turn into a theta trade, but it's no longer a delta trade. I thought this stock was going to keep breaking out. I saw it pull back, and I was thinking, okay, this is going to break out again. The energy sector's still hot. So I bought 2 more 105 calls and got bullish on it again. And I did that with, knowing that I had gains. So we're kind of steepening that up a bit. So trying to take advantage of the price run here. That's just me getting creative on legging into spreads. That's also part of the playbook, but that's still coming in the playbook. I haven't finished that part of the playbook yet. Dynamic long calls, that's me trying to leg into spreads. Nothing going on there. Adjusted bull call spreads. These are risk-free trades that I have gotten into on SLB Slumberger. I like to call it Slumberger, like Target. This was another energy sector stock on that same list we were talking about as we were looking at the screener. And I was thinking, energy sector bullish, and managed to get into a risk-free call spread. Started out buying $40 calls for $325. Bought 6 of them for $1,950 risk. Now you buy as many as you're comfortable risk-wise. And, you could take max loss on that, or you can use a stop loss. I would use a stop loss. It got moving in the right direction. Sold the 42.50 calls for 5 cents more than I paid for the 40s. So now we have a risk-free position. Max gain, $1,500, bullish, guaranteed $30 gain. Just rooting for this stock to keep running. These options are good through May. So risk-free trade. And then I have another one on consumer staples. This is one Andy and I did in a webinar quite some time ago. We were talking about inflation and that consumer staple prices might rise. And so we were looking at it back in here, back at the end of the year, and sure enough, boom, they popped, but then it came back down. And it's really not further ahead now than it was back at the beginning of the year. But we have a risk-free position on it because we bought $67 calls for $640 and left a pending order to sell $73 calls for $640. Got filled at $645, and now we have a risk-free trade there on the consumer staples. So legging into those risk-free spreads is fun. I don't know if I don't have a short strangler going on right now. And then I have just a bunch of random stuff. I've got an energy trade. That oil long, one single long futures contract. Energy, like trading oil futures, is definitely not for beginners. It is a lot of leverage. We're using $1,155 leverage, and you can watch like each tick's like, boom, like 10, $20. It's moving. We've got a nice return on it, but that was a high risk trade. Silver's down $500 from the open. Corn, I just opened up this morning, bought a single contract. It's down $187. I also bought the wheat contract this morning, and it's already down $1,300. So you can imagine how easy it is to get on the wrong side of the trade. And I just basically put trail stops on those. So, /ZC. I see price of corn here with a bull flag. Knowing that we've got some of these concerns about base commodities like grains, corn, wheat, soybeans, etc. Expecting this to break out and run, I got a stop loss down here below support, but that's a trail stop set just bigger than the ATR. So what I'm hoping is that starts to run and reduce my risk out of the gate. And I basically did the exact same thing on wheat. And so, whoops, that's ZC again, ZW for wheat. And looking at this, big pullback, I got hyper excited, pulled back down to the rising 20, and I'm not sure it's going to rise, but I got a trail stop on it for 100 points, which is a lot of risk. I mean, that's, if you look at where the stop is down at 1046 on this, stop down at 1046, that's about $4,600 risk, $4,500 risk. Pretty healthy risk, just speculating on the price of wheat rising, and those contracts are good for 38 days. And with futures, I mean, if those are exercised, the theory is that I am trying to buy, a train car full of contracts worth of wheat. And, there's cash settled, but if you were working for General Mills and you were buying wheat, so you could make, Wheaties, I don't know who makes Wheaties, General Mills, I guess, I don't know. And you were trying to lock in the price, you could buy a contract, however many contracts you wanted, and then you could actually take physical delivery. So futures are not for beginners. Corey developed a futures class. If you're interested, you can check that out. So, and then I just got a bunch of unallocated random stock. Tried to buy some calls on Baidu. They're not doing so hot. They're getting beat up, losing big, $1,240. Do I dump those? Trying to get risk-free. Has not gone risk-free. Got ripped, got back up. I'd kind of written those off at max loss because it ran so hard against it after I bought them. That order out there is a ways out. These are good for... that target's just too far out there. So this is I could do the same thing I ended up doing on that other trade where, look, I can throw money at this problem. 165 by 175. If I could go buy 185 calls out of the money, these are only good for 24 more days, and I'm just throwing money at the problem. 185 calls, I'm throwing... Could buy those for 118. I have to buy 2 of them, because that's the number of contracts I'm dealing with. And I'm increasing my risks $236. Okay, now, instead of trying to sell 2 contracts for $9.95, I'm going to try to sell 4 contracts. So let me go analyze this trade. And I'm going to try to sell 4 contracts. And I don't need $9.95. I need $7. No, $6. $5.50. $5.55. If I do $5.55, $5.55, that gets the $5.55. Boom. That gets me to a break even, minus $2, max risk. And what that's going to do is it's going to lower this target, hopefully down to about resistance. Would be my hope. If that works, we'll see how that works. 4 contracts, create duplicate order. Price has got to drop up 21 points to about 167. Send right about resistance. So that lowers that target. So if I get a pop, it'll go risk-free into a butterfly. But I just threw money at the problem. I mean, I just took more risk to see if I could get my target lowered, and that may or may not be smart. I mean, this is sometimes when it works out, I feel like a genius, but when it doesn't work out, I feel like a chump because I just increased my risk $236 or something like that. And I only have till April 14th, so tick tock, come on, move, Baidu. May or may not be smart. Just some stock on Dix. GFS is a call spread. I need to move that to my call spread group. Bear call, credit spread, boom. International paper, some Kraft Heinz. That's our Kraft Heinz. Looks like our options expired. We need to write some more options on it. Speculating on Palantir with 200 shares. Prudential stock. These are kind of unallocated stock positions for the most part. RSX, that was our naked put on the Russia ETF. That is not going well. Those expire in April, and they've delisted those. So we're probably going to just take a loss on that. RTX, Raytheon. This is me trying to leg into a risk-free spread on Raytheon. And it's moving in the right direction. That target's a little ways out there. So this would be kind of the same thing we did here. I could try to butterfly this and lower that target. We already have $1,860 risk, so doubling down on this is kind of silly. These are at least good through May, so I have a little bit more time. But I go buy some 120 calls. So these are 5 points apart. So I add to my problem. Buy some 120 calls. They're only 30 cents, so it's going to cost me $300 at 10 contracts. That may take a minute to get filled. Now, I'm going to double up this to try to sell 20 of those for half as much. So, analyze trade. I'm currently trying to sell those for $1.86. Which is, I mean, I can sit and do the math. It's really simple. Look, I was trying to sell 10 contracts for $1.86, 1.86. I just added 29 cents to the cost base. So, plus 29 cents. Sorry, $1.86, 1.86 for those original 110 long calls. Buying these 120 calls way out of the money for 29 cents, so plus 0.29. So now we're at 215, and I've got 20 contracts, so I can divide that by 20. I need to sell those for, whoops, let me just do it. Did I get that right? 215. 10, that's more. I need to sell them for more than that. I don't think I did the math right on that. Let me see here. Analyze trade. Okay, 20 contracts. And it was saying just 10 cents, but I don't think that's the case. Whoops, not $10, but 10 cents. No, I need to get these out for, do I need to sell them for $1? It's times 100 shares, so it's $1. Buck, that leaves $150 risk. What did the calculator say? Okay, let me do the math all over again. And just why my head was spinning is I forgot to multiply it by 100 shares. So we need to get these sold for, so if my average cost base is $2.15, which is what those two added together were, and I'm trying to turn it into a butterfly, 20 contracts, divided by 20 contracts, 10 cents more, 107. So if we get that up to 107, that's pretty darn close to break even. It's just barely off, 107.5, 108. So I need to get those for 108. I'll go 110. Okay, what I'm hoping to do, and if this makes sense, is just, again, doubling down. This is like, I don't know, hitting when the dealer is showing a 6 or 7. Like, I'm just going to, hit, double down, or whatever. So it was this 1.075 times, 100, so 10, move the decimal point. Boom, boom. $1.07. So there we go. So $1.10. If I do this, the goal is to lower this target down much more realistic. So I'll go cancel, replace order, sell 20 shares for $1.10. And it's technically $1.08, so $1.08. That brought the target down, so it's easier for it to hit that. Okay, we'll see if we can get that risk-free. This might just be money wasted. Okay, so that, just kind of brings you up. We got position on Suncor Energy, UNP, Union Pacific, Valero position. That's me trying to leg into a spread. That goes with the butterfly. Take that back. That was in my little broken wing butterfly section. Butterflies, VLO. Okay. Then a couple stocks that just aren't performing well, that aren't beta weighted right. So, again, lots of stuff going on in the portfolio. Okay, let's talk about some new positions. If we go the energy sector route, we already have Oxy. We're talking about Marathon Oil. That looks bullish. Popped. Fang. These were the ones we wrote down. Potential breakout. Hess. Good energy potential breakout. Halliburton. Apache. CTRA. ConocoPhillips. Kind of like the ConocoPhillips breakout. And I could, how I build a trade out here, I could go non-directional and just do like a credit spread on it and say I don't think it's going to drop. And I could go, there's a little premium in here. I usually follow a delta of like 15 or so. I'll do these 93s with a delta of 16. Promise to buy it at that and see if I can squeeze 50 cents out of a 5-point spread. 57 cents. 5-point spread. That's a simple bet that it stays above 93. That's just above the support. That's tight. That's too tight for a credit spread. I don't like it. I could just buy long calls. The implied volatility is back at the medium range. Earnings is coming. This could just be a simple long call position. I don't need to do anything fancy. I'd probably want to go buy some August calls. I could do a call debit spread, or I could do a broken wing butterfly. Buying long calls is, typically you buy anywhere between delta of 60 to 30. And I could take I could say, I think it's going to go above 115. I could spend, $515 on that. Have $515 risk, unlimited upside potential on ConocoPhillips through August. I'd have to believe that was going to head out past 115, 130. That's now to the money call speculation. You could be more aggressive and buy in the money. Say, okay, I buy these 100s for go out longer term August, 151 days, $100 calls. Cost you $1,100, $10.95. You'd have unlimited upside potential. So this is where I really like the idea of the butterfly. I could do like a 105 by 115 by 105 by 120.25. So I could do something like this. I think it's going out towards 120, 125. Usually shoot for a delta in the 25 ballpark. I could choose between these two. $3. Okay, so it goes something like this. Analyze, buy, butterfly. First strike out of the money is the 105. So I drop this first purchase back to the 105. Okay. It cost me $4.88. I'm not sure I'm going to like it yet. $4.88 max gain would be $1,000, and it would give me a delta of 22. This would be the same as buying 22 shares of the stock, which 22 shares of the stock at the current price would cost us no commissions. That's one advantage of the stock. It would cost us $1,130. So I can create a stock-like position with this purple slope for $488. And I could see if I can get filled for like 45. And then I like that. That works. So this is a 105 by 125, so a 20-point spread on the bottom, and then just a 5-point spread on the top. And I could take that out to like 135 and maybe have a slightly lower cost. 40. It gives you a delta of 18. I actually like the 130 better. Okay, I'm going to offer him 485, and I will do 2 contracts for $970. Okay, that may or may not get filled. Let me set that good till canceled just in case. So I'm just thinking out loud. Again, just kind of walking through the routine. I also was interested in checking out that ag stock. Mosaic, super bullish, Monsanto. What's that Monsanto? MON. They changed their symbol up. No. Agrium's another company. Oh, Monsanto's done something different with their symbol. I'm not sure what it is. I guess it's no longer traded under that. MON. Looks like something. I don't know what the MONW was, but potash. Nothing coming up there. Mosaic. Phosphate and potash. So it's nutrients and fertilizer. That's the first one. It's breaking out. Agricultural play. Go with June options. We could do credit spreads, but I want to be directional on this one. Same type thing. We could build a broken wing butterfly. So I find the delta of 25, and that's the one I'm selling. So I'm going to buy 70s, sell twice as many 85s, and then buy a 90. So I'm going to go analyze buy, butterfly. First contract's the 70 strike. I'm just out of the money, $3.31. Maximum gain $6.99. I like that. Try to get it for $3.30. I'm going to take that to about a $2,000 position size. Getting the delta, we'll do $1,980. 6 by 12 by 6. Now you position size that 1 by 2 by 1, 2 by 4 by 2, whatever you're comfortable with. Just position size to match risk. This will give us a delta of 117 for $1,980. Let's see if we can get filled on that. Broken wing butterfly. And we're basically speculating on this thing. We're just ripping. And I don't know if it's going to rip. It could. I think the concerns over food shortages, and just a general increase in crop prices and concerns about supply, the production yield's going to need to be high, so they're going to do fertilizers anyway. So Mosaic is an agricultural play. You could also check out like basic materials, like Nucor came up on our little list that we're looking at. Nice little breakout, 140. I'm kind of loving the broken wing butterflies today. Go out to July. Delta of 25, 23, 27. Analyzed by broken wing butterfly, 145. I can do 150 here. 150 by 175, so 25 points. And I'll go to 85. 540 debit. 960 maximum gain. Try to keep it around that $2,000 risk profile. You position size according to your risk tolerances. This is just a bet the Nucor runs. That one should get filled because I'm not shaving it much. Okay. So that's just running through my routine, speculating on some bullish movement. I probably want to look at some bearish stuff. First a flow serve. Breakout, no. I think First Solar's got upside potential. Anytime that whale runs, Solar tends to run. That could be bullish. I saw a chart of EA Sports that I thought looked bearish, Kiska buy-ish. What does their implied volatility look like? Kind of medium. Earnings is coming. I expect implied volatility to rise. I could just do a straight up put option or maybe a put debit or even a bear put butterfly. This would be pure directional speculation on the put side. I'll just do a put debit spread. Let's go 125 by 115. Because that's about how far I think it drops. 115 target. So you buy, first strike out of the money, sell the target, brings the cost down to 375. Little directional speculation. I'll do 2 contracts and keep that risk modest. If it drops to the 115 target, we stand to make a nice little return. Bear put debit. And the idea here is Kiska buy. It's like lower low, lower high, lower low, rallied up, volumes tapering, inside doji, support could become resistance, 20-period falling moving average, another leg down, boom. Don't expect it to drop more than 115, maybe just down to 118 again. Just a pure directional bearish speculation, kind of a swing trade. Okay, got filled on that. Let's see if we can get filled on the others. But that's just kind of what I've been thinking about, working on some shorter-term directional trades with fixed risk graphs. I'm not open-ended risk graphs. I don't know which way the market's going. So everything I just did has fixed risk graphs, and we can stop loss those out. If the butterflies run the wrong way, we exit when we hit our pain threshold. You could take that same trade that we just built out on Mosaic, for example, and I could say, you know what, if it breaks back down below this 9-period moving average or breaks back down below $60, I was wrong about the directional speculation. Do I want to... I should be able to get filled at the 330. It should. We'll see if that gets filled. But if it breaks back down below $60, I was probably wrong, and I could pull the trade off at about a $700 loss on this position size. And so I could set an alert, hey, let me know if this breaks back down below 60. There, we got filled on it. How much did we get filled for? At or below 59.25. Dump that broken wing, it is not going up. If that alert gets hit and that position kind of gets down to that 60.25, what do we have that alert at? 59.25? 59.25 clear violation would be about $800 loss. If you were doing a 1 by 2 by 1 position, you're probably risking $100, $200 tops. Like, not even that. So, and we just got filled on our EA put. Yeah, okay. Yeah, so we've got a couple trades going on, some directional speculations. Let's quickly look at the S&P before we call it a day. You know, I have no idea which way this market's going. I get the kind of kiss there. I can see the downside risk. I can see where it could break out. I have my doubts about this rally, particularly with the way the volume tapered off. I'm leaning more neutral to bearish. We'll see. Thank you for listening to me talk out loud for the last hour, whatever we just did. Hope you enjoyed this week's edition of the Mentor Club. If you have questions, shoot me an email. You have access to that. And we'll see you guys on the flip side.